in between those questions ka trial balance ka understanding again. Correct, correct, sir. And rest of the data.
Okay.
So one second.
This is a question. No?
So this is yesterday's question.
Yeah, another question yours.
Yeah, just 1 minute. We'll just have a quick revision on this question.
Yes.
Okay. So as an example, Tom, we need to revise where does the item go, whether it's categorized as an expense loss or an asset. Then where does it go in the balance sheet or the income statement? The way I explained you the formats yesterday, here's the format, correct? So we understood yesterday there is this concept of COGS, COGS, cost of goods sold. There is opening inventory. Tom, you can see the screen, right? Tom?
Yes, yes.
Yeah. Opening inventory plus purchases plus wages plus any kind of factory expense less closing inventory. That was your COGS ka balance. Now, after getting COGS, we understood that we need GP. We need to find GP. So we understood sales, COGS, GP, income statement, rough income statement, sales, COGS, gross profit. Add other income, less operating expenses, categorized under officer admin, selling and distribution. What you get is EBIT. Add non-operating, less non-operating, you get PEBIT. PEBIT may less interest, you get PBT, less provision, you get PAT. Any appropriation to be done ahead. Then also we also did balance sheet yesterday. Assets, non-current, current. The non-current includes property, plant, equipment, land, building, intangible, tangible, all of them. Current, inventory, receivables, cash, and so on. Equity and liability, equity, share capital, reserves, non-current liability, current liability. The balance sheet closes. Tom, we are good?
Yes, yes.
Yes, sir. Thank you.
That we got that. We in WhatsApp group, I got it.
Yeah. Tom, just revising it. These things, they will require flow, na, sir? So
yes,
objective is to revise it.
Yes.
Okay. Basically, I was doing for everybody, but since you were only there, no problem. We'll discuss
Well,
it.
most of the people are commerce background, no?
Oh, but okay. Oh, that's the reason they have not joined.
Yeah.
Yeah,
Like,
I get that.
They are
But
commerce background means they may not come.
No
I'm
problem.
science background, but I like these accounts.
No. I totally respect their decision. But Tom, we have to do now. I mean, as a college, we have to.
Yes. But even if you have a commerce, they have a commerce background, it will consolidate their ideas. You know,
Yeah.
you don't have to work hard.
No personal choice. No problem. Let's continue. 1 second, sir. 1 second. Yeah. So discussing admin expenses. Admin expense, as the term goes, it's an expense. It's always has a debit balance. It goes under office and admin. Advertising, again, expense, operating expense. It goes top. Operating expense goes, advertising goes to selling and distribution. Cash at bank, it's a asset, balance sheet item, current asset. Trade payables, Tom, it's a creditors, that's your balance sheet item, current liability, it's a creditor balance. Trade receivable, Tom, we both can talk right now. We have to be at par.
I think we can skip it, no problem.
Sure?
Yeah, I know.
Absolutely. Thank you.
Because these things are basic things.
Fine. So just give me a second. I'll take the new questions which I had sent to you.
Yeah, I have seen in WhatsApp.
Yeah. Just 1 second. Won't take much longer.
It's a lengthy question.
Yeah. But we are not doing the question today.
Yeah.
We are just discussing the trial balance of the very question.
Yes. I think it is here. We are lucky that we are getting all debit and credit balances. Sometimes, they give together.
Yeah. That is the case. If you pay attention to the current question on screen, that is the case where I have skipped giving the both debit and credit balance, rather given you only 1 second, Tom.
Yeah, that is, it takes time. Sometimes takes time. No?
No, I'll tell you the logic behind it. If you are okay with the logic partner, it should not take time.
Yeah.
If you're okay with the 1 second, Tom, I'm not able to operate it. 1
Yeah.
second. Here it is.
Without balancing it, debit if you credit, we can directly go to income statement and the balance sheet and all.
Idea is, Tom, because we are always under the impression that in our academy, candidates will be balanced. We'll be having both science and commerce equally, or maybe a slight skew. So we prefer at least they get an idea about where to post the item, because see, normally a balance sheet question comes for a 15 marker.
Yes.
And at least if you post it correct, you can comfortably score 8, 9, 10 somewhere if you have posted it correct. If you say, sir, adjustments could go wrong, fine. So at least out of 15, 8, 9 is not a bad score. I mean, given that a person is not from commerce background. So my objective is the student should get at least first grip about the trial balance, and steadily, once the trial balance is understood, we can move ahead based on the further information. Tom, correct?
Yeah.
Okay, sure. Let's have a discussion here, sir. Yep. So we were discussing where does the item goes. So following are the balances that have been extracted from the books of Haldiram as on 31st March 23. So do remember, the year of this company would have been 1/4/2022 to 31st March 2023. All the data is from the ledger accounts which were closed over here. Come on, all good?
Yes.
Okay. Now we know the advertising expenses, the ledger closed at 90,000 rupees.
Yes.
Advertising expense, it's an expense.
Income statement.
Income statement. Very good, sir. Income statement. It falls under operating expense category.
Operating expenses.
Lovely.
And cash at risk is current
asset. Very nice.
Balance sheet.
It's a current asset.
Current asset balance sheet.
Balance sheet.
Creditors is current liability.
Lovely. Continue, sir.
Debtors is current asset.
Fantastic.
Directors remuneration is this one expenses or operating expenses.
Operating expenses, we'll put it under office and admin.
Office and admin. Yeah.
Lovely. Continue, sir.
Head office running cost is also office expenses.
Yes, sir. Operating expense, office and admin.
Interest on loans, interest on
long-term loans.
A loan is last it will come interest only.
Yes, it has a separate heading, interest.
It's not investment and all.
It's a financial expense.
Here is a problem. No, interest on long-term terms can be investment.
No, Tom. Here, when you read it ahead, you will realize that there is a separate investment income.
Yes.
Interest on long-term loan, there is an investment long-term, and there are long-term loans. So
yes.
If nothing told, then it is of course long-term loan you had borrowed.
Yes.
It becomes your non-current liability, sir.
Yeah. Sometimes it is this. Sometimes this comes like that.
Yes, sure. Investment income.
Income is asset only.
Sorry.
Investment income is asset only. Asset.
No, sir. Investment income.
Investment income is
in your income statement.
Either
other income. Yes. Other income or non-operating income, depending on how you have defined your company.
Yeah.
Preferably, we can take it as non-operating.
Yeah. Investment long term is asset only.
Sorry, sir.
Investment long term is there.
Is non-current asset.
Non-current assets.
Non-current asset. Good job. Continue, sir.
Long-term
loans.
Long-term liability.
Fantastic. Non-current liability.
Materials and manufacturing costs comes under COGS, So we have COGS.
Very good. Very, very good.
Ordinary dividend paid.
Ordinary dividend paid, we'll treat it as appropriation. Appropriation from the PAT, profit after taxes. Good job.
Ordinary share capital.
Yes, sir.
Ordinary share capital is capital only liability.
Correct. So
under the heading capital plus liability, na?
Yeah. So, under the heading equity. Correct.
Plant machine non-current asset.
Non-current asset.
Depreciation we have to deduct, na?
Adjusted from the
Adjusted
non-current asset.
the value, the
This is
value.
because this is gross value.
Yeah.
This is gross, and this is working like depreciation till date.
Till date.
Okay. Premises at cost.
As on 31st, 22. 23 we have to calculate.
Correct. 23 we have to calculate.
Premises non-current asset.
Non-current asset.
All depreciation also we have same 22.
Same like plant.
We have to deduct it and we have to take the depreciation
the current year depreciation as well. Correct. Continue, sir.
Profit and loss account will go to that current
we'll treat it under equity. Under reserves.
Reserves and all.
Under retained earnings. Because this is last year's, na? So this will be more like accumulated types.
Accumulated types. This year's we had to add it and keep
yes, sir. Yes, sir.
Sales is top line.
Very good. Revenue.
Stock on is inventory, that is COGS.
COGS, that's opening inventory.
Yeah. Wages and salaries will in gross profit.
Hold it. Now see, wages and salaries now.
Administrative staff, it is in operating expenses.
Correct. Operating.
Manufacturing staff, it comes under COGS.
COGS, very good.
Wages and salaries and sales staff, it is distribution cost.
Selling distribution, fantastic. Tom, we'll revisit this question when we are solving the final accounts. Correct?
Yes.
Right now, our objective was only to discuss the trial balance.
Yes.
All good, Tom?
Yes.
All good. Fantastic, sir. Very good performance. Okay. Tom, we'll take one more question.
Yeah. You are putting in WhatsApp group, no?
I've already put.
I have seen it. That's same.
Yeah.
That debit and credit separate. So that one.
Yeah. So Tom, giving you I think this one is relatively much simpler.
Yeah.
Let us start. So we have Tandooi Sweets. We are preparing trading P&L for the year 31st December 24. 24. Okay. So this time December. So this time the year would be 23
to 24. January 23. December 24.
December, hai na? Yeah. So
calendar year.
31st December 24.
Calendar year.
A calendar year. Perfect. Tom, the opening inventory goes under?
Opening is COGS.
COGS.
Sales top line.
Revenue.
Purchases COGS.
Purchases COGS.
Purchase return, we had to deduct it. 80,000 minus 4.
Reduced from the purchases. We are reduced from the COGS. Correct?
Yes.
Continue, sir.
Sales return also top line minus sales return.
Reduced from the sales. Now discount, Tom. Now discount item, if it's a debit item, it will be treated as an expense. If it's a credit item, it will be treated as an income. Because it's discount given under credit, we'll treat it as discount earned.
So bulk purchase, bulk sales.
Other operating income. Yeah, we can add it to sales also. Other income, yeah, we can add it to, or below sales, we can add it.
Yeah. Actually, that sales, because of bulk sales, we are getting some discount. Is it so?
This must be discount earned on purchase, not on
purchase only, not in sales.
This is what discount we have earned. Na? So this must be on purchases, sir.
Purchases. Because bulk purchase discount.
Yes. Continue.
Carriage inward.
Now, carriage is, that bhada, the item which carries the luggage into the factory. Okay. And when you say carriage inward, it's towards getting raw material into the factory or some kind of material into the factory.
Expenses.
So, expenses for sure. This goes into COGS.
Yeah.
Tom, it's carriage inward, right, sir?
Inward, yeah. Carriage outward is also.
Outward, it would have been under selling and distribution.
Selling it. Both are expenses only.
Correct. Carriage means expenses. If it's inward, it is towards
Yes.
It's towards getting the goods within the factory.
Yes.
If it's outward, it's trying to carriage incurred towards sales of the goods.
But we have to add it in the same top line.
No. If it is carriage outward, we would have taken it as a part of selling and distribution.
Oh, I see. It's expenses.
As an expense.
Yes, yes, yes.
Tom, all good?
Yes, yes.
Tom, sir, creditors. Creditors
What
with
is current assets?
current liability.
Current liability, yeah.
Tom, your favorite, carriage outward.
That is outward, yeah. I think that is we are paying it,
Paying
We
it,
are
it's an
paying it.
expense, but falls under which head?
Purchase. From
No,
we
no,
have to
sir.
deduct it from purchase
No, sir.
or distribution cost.
Distribution cost, selling
Yes.
and distribution, because this cost we have to pay for selling the goods.
Yeah.
All good, sir?
There are 4 items: sales return, purchase return, carriage inwards, carriage outwards. Correct.
Uh, No, what is the relevance of your line?
No, what I'm saying is that this when we adjusting, these 4 things has to be mined out because we are science background. No, we always combine
No. Only two, Tom. Purchase return and sales return. Only two.
sales return.
And they are very friendly. If you appreciate, purchase return has to be subtracted from the purchase. Sales return has to be subtracted from the sales. I don't think any much of effort is needed towards thinking that.
Both to be subtracted from the respective sales or purchase.
Yeah. And if you say purchase return and sales return, purchase return has to be reduced from the purchases. Sales return needs to be reduced from the sales.
Yes.
Good. All good, sir?
Yes.
Okay. Fantastic. Next. When you say bills payable,
it is a liability.
Current liability. When you say wages,
it is in the factory. It comes in COGS.
COGS. Fantastic.
Share capital liability, long-term
share capital is a equity under the heading equity.
liability.
Salaries, if nothing told, we'll treat it under operating expenses, under office and admin. Plant and machinery,
non-current asset.
Non-current asset.
Furniture, non-current asset.
Debtors.
The debtors is non-current current assets.
Bill receivable, again current
receivable, current assets.
Cash in hand, current assets. Tom, traveling expenses.
Distribution expenses. It comes in.
Distribution.
Oh, it can be big. If we have to tell not specifically.
No, we always in accountancy, we are always under the assumption that this cost is incurred towards
distribution cost.
Yes. Towards
salesperson will be traveling and all.
We always are under that standard typical assumption that this expense we have incurred towards selling goods.
Okay.
Continue.
Factory it is COGS. COGS.
Rent and taxes.
Rent and taxes COGS only it comes because taxes, factory taxes and all.
This is debatable. You can take it under COGS also. You can take it under operating also.
But if you are taking in factory COGS, we have to mention it, right?
Yeah. We'll write a note for this.
Yes.
In one of the batches I was teaching, the student said, no, sir, we'll take it under office and admin. No problem. Then we'll write a note for that.
Yes.
Okay. Continue.
General expenses is expenses only.
Office and admin.
Office and admin.
Operating expense. Office and admin.
Insurance is also expenses.
Lovely. Operating
expense also can be factory insurance also, and can be.
If the question is silent, Tom, again we consider that as office.
Office expense.
Yeah. Adjustments we'll do it later.
Correct?
Yeah. So today's point was to revise the trial balance. So technically we are through with 3 trial balance. And I think we did good. Correct?
Yes.
Tom, we can take a minute's break on this.
Yeah. No problem.
And post that trial balance is through, we'll revise COGS.
Yeah.
We'll discuss depreciation.
We can go a bit fast also, no problem.
Yeah. We'll discuss depreciation.
The candidates are very fast taking, so we can go fast. No problem.
Candidates what, sir?
Candidates taking it very fast, no? We can go fast also, no problem.
Sure. Thank you. Just a minute break we'll take. Then
we'll no problem.
Tom, just 1 minute. Huh?
Yes, yes.
I got everybody mad at me for it. So, I got everybody mad at me for it. So, I got everybody mad at me for it. So,
Tom, let's continue. Chalo, let's move on. So I think, Tom, you're there?
Yes.
Last lecture, we had discussed COGS. So here you can see sales COGS is GP, gross profit. Now, 25 units sold at 40 gives you 1,000 rupees. The Tom,
Yes, yes.
shall I move on?
Yes, yes.
Yeah, just check this out. So the COGS is basically opening stock that was 5 units at the rate of 20, that was 100 rupees. In the current year, the company purchased 45 units further at 30. Together, the purchase was 1350. In the end, the company was left over with 25 units at the rate of 30. That means 750. So, Tom, 100 plus 1350, that's your 1450. And 750 is the worth of closing. So, 700 should be the worth of the COGS. Come on, all good?
Oh, yes.
Correct. I think here there's a misprint. This should be 25 and this should be 700 by 25. The misprint here. 700 by 25. Okay. So that gives you a GP of 300 rupees. Correct?
Yes.
This concept, what we followed, is called as the matching concept, that whatever we sold in the current year is matched with what we produced or purchased in the current year. All good, sir?
Yes.
Yeah. Okay. Tom, just 1 second. हाँ मैम लेक्चर में हूँ, I'll call you later. Yeah. Yeah. Next, depreciation charge. Depreciation. Tom, depreciation is the loss of the value of the asset due to usage, wear out, consumption, efflux of time, basically obsolescence due to technological change and so on. Correct? That's your depreciation. So depreciation is defined as measure of wearing out, consumption, or other reduction in the useful economic life of the non-current asset, whether arising from number one, passage of time, number two, obsolescence of technology. It's a charge because you cannot pay depreciation. It can't be paid. It's a charge. It's a year-on-year basis. It's charged annually on non-current. That's long-term asset. If it's tangible, Tom, important. If it's tangible, you call it depreciation. If it's intangible, you call it amortization. You can write it down somewhere, sir. Tom? Hello?
Sir.
Yeah. So if it's a tangible, you call it depreciation. If it's an intangible, you call it amortization. Moving ahead. For normal wear and tear, normal reduction in the value of the asset, we use the word depreciation. Okay. If it's a one-time big fall, we use the word impairment. From normal wear and tear, we use the word depreciation. If it's a one-time fall, we use the word impairment. Come on, all good?
Yeah.
Lovely. And it's always on the value of long-term asset. Any fall in price does not mean depreciation, but it's a fall due to normal wear and tear. Please read this slide, sir.
Yes. Any fall?
No, don't have to go for that. Just read it personal level.
Yeah. Only for long-term assets only that it comes.
Yes, only for long term. Yeah. Continue, Tom.
Yeah.
Okay. Depreciation. Adjustments are required because virtually all non-current assets have finite life.
Yeah.
Exception is, of course, land. Land, usually we do not use the word depreciation, correct? We don't depreciate land. Depreciation is defined as the measure of wear out, consumption, reduction in the value of the non-current asset arising from passage of time or obsolescence through technological or market changes. Not attempt to reflect the value of the guys. It's not an attempt, Tom. It's not an attempt to reflect the value. Rather, the purpose is to charge the price to the P&L. I mean to say, see, you purchase non-current asset, you cannot take it to P&L directly. So you take it to the balance sheet, the absolute amount, and every year in bits and pieces you charge depreciation, and these bits and pieces are charged to the income statement. So Tom, ideally depreciation ka intention is not to show the fair value, rather the intention is to charge the asset value to the P&L account. Come on, all good? Application of depreciation is also a matching concept, like we did COGS. Please read it once again, Tom, and we are through with this slide.
Yes, sir.
All good?
Yeah.
All good. Lovely. Let's move on. So through with the depreciation ka theory, let us now see the calculations we had learned in the past. Tom, this is just an entry. You remember depreciation, you reduce from P&L, income statement, treating as an expense, a charge, and reduce from the balance sheet, the non-current asset. So there are two effects of depreciation. One, it will be charged to the P&L account. It will be charged as an expenses to the P&L account. Number two, it will be reduced from the balance sheet. That's the non-current asset. Come on, Tom, all good?
Yes.
Method of depreciation. The definition of depreciation also make it reasonably clear the manner in which the asset's life diminishes. For example, if it's a financial asset. So financial asset like a lease on some property, the lifespan is fixed in terms of years. Physical assets like plant, property, equipment, they deteriorate much rapidly because of the flux of time, right? Or technological obsolescence. Some assets like computers, again, technology affects them before their physical life wears out. They lose value, or they lose the spirit, they lose the skin in the game, because no longer they are that you know relevant or that much productive. So the value of these kind of assets drops significantly at a faster rate. Come on, all good, sir?
Yes, yes.
Straight line method, Tom, we have done this formula in the past.
Yeah.
Yeah. Straight line method can also be expressed as a percentage of the cost, or straight line method is estimated cost minus residual value divided by useful life. Just 1 second, sir. Tom, take 1 minute, we'll continue.
Yeah.
Tom? So discussing the straight line method, right? Estimated as a percent, it can be estimated as a percentage of cost also, or ideally you can also take it as this formula. Normally we take this formula. Cost minus residual value divided by life, right? Tom, you there? Hello?
Yes, sir.
Example. A company purchases a machine for 1 lakh, estimated salvage is 20, life is 5 years. So if we want to find depreciation per annum, it will be 1 lakh cost minus 20 residual divided by 5 years ka life. That's 80 by 5. That's a 16,000 per annum. Okay. Tom, this is the schedule. Just check. Can you prepare the schedule?
Yeah.
Comfortable, huh?
Yeah. 1 lakh minus 84,000 minus 16,000, all 84,
Here,
16.
na, at times you have to be very careful about the dates. Now, what I'm trying to infer, like suppose in this example, suppose the asset was purchased at the start of the year. So let's say a 1/4, maybe a 25. Okay. So this depreciation will be for the year 24, 25. Come on, Tom, correct now?
Yes.
25, 26, we are estimating 26, 27, 20, 24, 25, 26, right? This should
Yes.
be 25, 26, my bad. Then this should be 26, 27, 27, 28, 28, 29, and 29, 30. That's how we estimate the depreciation. However, suppose it's never purchased on the first date because it's a matching concept, time dependent. We have to be very careful about how much depreciation you charged in the current year. For example, in that example, we purchased it on 1st October 25, and our year ends on 31st December. The calculation of depreciation would never change. It will be the same, cost minus residual value divided by n. Cost will be 1 lakh, residual is 20, spread across 5 years. That's going to be 16,000. Calculation never changes. But if we go for year-wise, time-wise, so in the year 25-26, the opening book value, as we know, is 1 lakh. And we'll charge depreciation only for 6 months. Because in this period, we own the asset only for 6 months. Come on, Tom.
Yeah.
Correct, no?
12
So,
minus 9.
Oh, sorry?
12 minus 3, 9.
12 minus 3.
Yeah, that October, no, the 3 months, only 3 months we are using.
We are making it 31st March, so 6 months. No?
Yeah, the 31st March. So
the
6
year
months.
is 1/4
6
to
months.
31st March, right? 6 months.
6 months we are.
So we'll be taking 8,000 in the year. The closing book value would become 92. Tom, is it correct? Tom? Then for 26-27, the opening is 92. But this year, because it's fully there, it's 16,000 depreciated. Come on. Are we clear, sir?
Yes. Yeah. For that first year, we have taken out a 6 months depreciation.
Exactly.
So the closing balance will be 1 lakh minus 8,000.
Correct. So we need to be careful that yes, for 12 months, it is 8,000. We get the point. But if you have not used it for 12 months in the year of purchase, I mean, if you have purchased it for a period lesser than 12 months in that year, then indeed your depreciation for that year will be lower.
Yeah.
Makes sense now? Now,
Yeah.
if I just complete this schedule, let's say it was bought on 1/10/25. So in this year, it will 1/10/20, 1/10/25 up to 31st March 26. Then, Tom, help me. 92-16 is 76.
Yes.
27-28,
76 minus 16, 60.
Continue, sir.
60 minus 16.
29. This is 60.
Minus 16.
16.
50,
44.
44.
29, 30. That would
44
be
minus 16.
4 minus 16.
28.
28. Now, in this year, in the year 30-31, because we estimated the life is 5 years while purchasing, so we know the sale date would be 30th September 30. Come on, Tom.
Yeah.
So in this year, that means the year 3031, which must have started on 1/4/30, ends up on 31st March 31. Somewhere in on 30th September, you must have sold this asset. That
Yeah.
means this year you will not be able to charge the whole year. Rather, it will be only for the half year again.
Yes.
And the residual comes to 20. Tom, this is a very important example if you may.
Yeah, yeah.
If you may want to write it somewhere, sir.
Yeah, yeah. When we go for buying the if 6 months or there, we have
Part
to part
Yeah.
only we deduct it.
Yes.
And here also, the last 6 months the asset is not with us, so we
Yes.
take only that
Absolutely.
wherever the time period asset is there,
Absolutely.
we deduct that only.
Absolutely.
But sometimes my question is that if it is suppose if it is for 3 months only, then it won't be the 20,000 won't come. No, the residual value won't come to 20,000.
No, I did not understand the question.
See, here we are very calculated 8,000, 6 months only. Suppose if the asset is only for 3 months,
Then we would have taken it 4,000.
then we have this last residual value will be more, no?
No, Tom. In straight line method, the amount of depreciation is already computed considering the residual value.
Yeah, yeah, correct.
So if you change it, let's say in mid of the year, in mid of the time zone, you change it. So we'll have to rechange the depreciation as well. Like you take down the example, I'll frame a story for making you understand. You take down this data at least, I'll make one example, and or else in the current example only, I'll give you another example.
The current example is enough.
Yeah. Please at least write this much. I'll give you new story. The current example you see on the screen is if you bought the asset on 1/10/25. Our year is 1/4 to 31st March, and you bought it on 1/10. So
Yes.
the year 25/26, you had the asset only for 6 months.
Yes.
Mom, are you writing down?
Yeah, yeah.
Okay. Done. When done, please inform.
Yeah.
Thank you, sir.
Yes, sir.
I'm done.
Yeah.
Okay. Tom, in this example, the current example on screen, which is where you purchase the asset on the start date. Okay. Tom, I'll extend this example, or you want me to create a fresh example? I'll create fresh one. I think I'll be better off.
It's okay, sir.
No. I think else unnecessary confusion will arise. Let's create an example. Just give me a minute, Tom. Very important, huh, sir. Anybody watching the recording, this is very important. Pay attention. We purchased the asset on 1/4/25 for maybe a 2 lakh plus installation cost of 40,000. Expected life is 5 years. Estimating residual value after 5 years is maybe a 60,000. So number one, we'll find depreciation per annum. Come all good? Depreciation per annum under straight line method. So let's say it will be 2,40,000 because it's including the installation cost minus 60 divided by 5. So 240, 60, 180, 180 by 5 is 36,000. So every year the depreciation is 36,000. Tom, till here any question?
No.
No. Could you please solve till here, sir?
Yeah, it's correct.
No. I want you to write it down. I'll extend this example.
No, I wrote. No
All
problem.
right. Now, suppose example 2, extending. Suppose after 2 years, company revalued the asset upside yeah, let's keep it simple. Let's do the revalue. Let's keep it simple. The company estimates that the life will be further 4 years. Tom, initially when you purchased, you estimated the life was 5 years, right? But 2 years passed and you now believe the life will be 4 years. What happens? See, you had year 1, 25, 26. The opening book value was 2,40,000. You charge depreciation of 36. You got a closing book value of 204. Then in the year 26, 27, this is 204. Another 36. Tom, help me with 204 minus 36, sir. 168. Is it?
168.
Correct. Now, after depreciating this much, the company believes that now the life won't be next 3 years, rather it will be 4 years.
4 years.
Also, let's change the salvage value. Salvage will be 40. Tom, both the variables have changed. Got it?
Yeah.
The life also changed, the salvage also changed. No problem. So, the revised depreciation will be 168 minus 40 divided by 4 years. Tom, help me. 168.
32,000.
Sorry?
32,000.
32,000. And now, Tom, we'll be estimating the depreciation for the next 4 years. So
Yes.
27, 28, 28, 29, 30, 31, my bad. 29, 30, and 30, 31. The residual was 168. We'll charge 32 ka depreciation. 168, 32 is 136. 136, 32 is 104. 104, 32 is 72. 72 and 32 is 40. Tom, clear?
Yeah.
Yeah, please note this down. It's a very important example.
Yeah.
Done?
Yeah.
You done with this?
Yeah. I simultaneous because the concepts are clear now.
Love.
So we can write it first.
So Tom, what did you learn from the example? That here, what did we learn from the example is that what did you estimate the depreciation that can change with the passage of time? Things can be revalued. Tom actually wanted to revalue the asset upside, but then I realized that it will become too much accounting. Hence, I did not do that. Correct? I wanted to revalue it, but
then the revalue, that balance will go to where? Revaluation reserve.
Revaluation reserve. We have a little bit of revaluation, but
That balance of that turn-down value and that balance value and minus revalued value go to revaluation reserve, right?
yes, sure,
Yeah.
perfect.
Yeah.
Tom, all good?
Yes.
I hope you enjoyed it. It was fun.
Yeah. Because it is some base is there, so it is easy.
Super. Anybody watching the recording, this is a very vital example. Mind this one. Okay. Tom, I think this we have done in the past.
Yeah.
The depreciation will be 1 minus under, this is under reducing balance method or written down value method. 1 minus the residual value divided by cost, nth root. Come on, all good? Tom?
Yeah. Yeah.
Let's take this example. So 11,000 assets, scrap value 1,000. 9. Tom, we'll first take this example. 4 years ka life. Cost is 1 lakh plus 30. That's a 1 lakh 30. Residual value is 20. And I would like you to give me the reducing balance depreciation rate. Tom, reducing balance depreciation rate.
Yeah.
Tom, help me with this.
Yeah. 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 This estimated reduced
So, 20,000
minus first one is residual value is estimated residual value is 1.3 divided by cost 20 by 20,000 20 lakhs by 1.3 lakhs. So it will be so that 1 minus 0.15384 estimated residual value is 20,000 divided by 1.3 lakhs.
So Tom, this would be 1 minus 4th root of 20,000 divided by 1,30,000.
It is 0.3737.
37.37%. Come on.
Yeah, 37.
Tom, we are comfortable?
Yeah.
No doubts. No doubts, right?
No.
No. Now, here we are asked to prepare the depreciation chart table. So what do? Again, here 1, 2, 3, 4. We'll have the cost or the book value. That's 130. We'll have the depreciation ka rate. That's going to be 37.37% of book value. Then we'll have the closing balance. So we'll take 130,000 ka. $130,000 into 37.37%. I got a 48,581.
Yeah, 48,583.
Stick with what you got. Okay. Subtract that from 130. 81,419.
81,419. Yeah.
Hey, you write what you got, sir. 1 or 2.
81,419. No problem.
That's okay. 37.37%. 30,426. That's a 15,993.
$15,993. 993.
19,056. That's a 31,937. 31,937. Now, Tom, now because we know at the end we have 20 here, we'll take the difference. 11,937. Got it, sir?
Yeah, we are adjusting it.
Roughly, it's going to be the same number.
Yeah, it will be around approximate that.
Any questions, sir?
No.
We'll wind this up.
Yeah, no problem.
Just calculate this example. Just check out this example. If any question you may please ask.
Sir, the formula will be the book value into 1 plus R depreciation raised to N is equal to residual value, right?
Sorry?
That value, the book value into 1 plus depreciated rate raised to N is equal to residual value, right? That is the formula, right?
No, they have made it a wrong example. Tom, just ignore this answer.
Yeah.
They've done it in the wrong way.
It is like a compound interest now.
Yeah, they have not done it
Compound
correctly.
interest.
Yeah, 11,000. This is anybody watching the recording. Don't go with the numbers. You take 11,000. You take 11,000 ka 30%. Come on, all good?
Yeah.
And then follow the rest. Please don't go with the numbers here. They are wrong.
Sir, the formula will be book value into 1 minus R, the whole raised to N is equal to residual value. That is compounded negative compounding.
I get it.
Yeah, that is a value. It is like, so you will get the return value first.
Correct. All good, sir?
Yeah. Understand, sir? No problem.
Okay. So next item, which we take in the balance sheet, capital and reserves. The statement of financial position lists the assets owned by the company. We'll have capital, we'll have reserves, and we call it equity. Equity can be in three parts. It can be shares, that's a share capital, equity preference. It can be certain reserves created through revaluation, Tom. Those are the revaluation reserves created.
Property revaluation, right?
And it can be some kind of earnings which are being retained. All good, sir?
Yes.
Okay. Now, what's the share capital? It's a share capital. So, share capital, as the name goes, that's the ownership into the business, right? That's the ownership into the business. Owners of the company have invested into the business as represented by the common shares, that's the equity shares, or the preferred shares, that's the preference shares. Come on, all good, Tom?
Yeah.
Continue. Shares can have a nominal value, that's the face value, for the bookkeeping purposes. This does not, however, necessarily reflect the market value. So the market value and the face value are totally different. It is possible that the company will be able to find a buyer who will have to pay rather more. Come on. Of course, the market value will be totally different. As a company, I would like the market value to be higher than the face value. Tom, making sense?
Yeah.
Any questions, sir? Till here?
No. Market value will be higher because it higher or lower also.
Lower also. At times, there are companies which could have it lower as well.
LIC value become lower.
Yeah. It's absolutely normal to have that. Shall we continue?
Yeah.
Share premium. So, Tom, suppose a company has a face value of 100 rupees per share. It decides to issue the share at a price of 600 rupees. That means there is a premium. You call it security premium, or you also call it share premium of 500 rupees. Clear, sir?
Yeah.
Now, where to record this? Tom,
It is an equity
again,
in share
it's a
capital.
part of, yes, absolutely. It's a part of equity. Come on, all good?
Yeah.
It's a part of equity. Continue. These are the usages of share premium account. As per Companies Act, share premium can be used for these purposes. Can be used for adjustment of some kind of preliminary expenses, commission on shares. These are like flotation cost. Any coin losses or redemption on loan stock, debt. So any kind of flotation cost which is incurred for raising long-term funds, share premium can be used to set off the figure. Come on, all good, Tom?
Yeah.
Amortization. So like depreciation is used for tangible assets, use the term amortization for intangibles. Amortization is an accounting technique used to periodically lower the book value of intangibles. So let's say there is a license you have, Pfizer has purchased 5 billion, life is 1 year. So in the very first year, you will amortize 5 billion, take it to the P&L account. Tom, all good?
Yeah.
Reval reserve. Revaluation reserve, Tom, it's the line item, separate heading, for the purpose of maintaining reserves tied to certain non-current assets. So we kind of revalue land and buildings, and if we revalue them, the revaluation reserve, let's say for example, there's a non-current asset, land and building in our books of 100 crore. We want to revalue it to another 170 crore. So the addition of 70 crore, which will be reval, the second effect of this reval reserve will be under the heading equity. Under that reserves, under reserve will create a reval reserve of 70, because everything has to tally, match. We need a debit and the credit effect. Come on, all good? Tom, all good?
Yeah.
Lovely. Just check this example, very straightforward. So we had a building, 20 crore. We bought it 5 years back, depreciated 5 crore. Today the book value is 15 crore. But the market value is 22 crore. So we revalue it to 22 crore. So there is a revaluation reserve created of 7 crore. Come on. This is the only exception. The revaluation reserve acts as an exception to the concept of prudence. Tom, did we do the other day the whole concept of prudence and all? I think we did, no?
Yeah. Yeah.
Okay. So there is a revaluation reserve created of 7 crore, and now the book will reflect the value of the land and building as 22 crores. Retained earnings, that's the past profit accumulated. It can be used for dividend purposes. Tom, all good?
Yeah.
So with this, we wind up the chapter. Really, thank you, Tom. You were a good sport in the lecture.
Thank you.
So we have wound up the chapter today, and next lecture
Tomorrow we have class, I think.
Tomorrow we have a class. We'll do the final accounts tomorrow. Maybe we start again with trial balance, income statement, cash flow statement, balance sheet. Next 2-3 lectures will be around final account. Then management accounting ratios will take a slight time, and then one goodwill wala chapter. Okay. Tom, till 20th, I believe we'll stretch it. Sunday,
Yeah.
This Sunday, I'm not taking the session. As you must have got an announcement. Correct?
Sunday, I think we are supposed to have
Some
class.
exam. Yeah. Some test or some exam is there.
Yeah.
Yes. So prepare for that. All the best. All right. Thank you.
Okay. Thank you, sir.
Thank you. Thank you, sir.